Hey family, how's things going today? This is Dr. Financial Literacy. Today we'll be touching on credit score and also property evaluation. I got some good news today. The credit union sent me information regarding the evaluation of the property, so we jump on in and get into that. All right, let's go ahead and start this together, and hope everyone's having a great day. I am feeling good about this. This is good. So thank you very much for stopping by. All right, this is day 17. The credit score, my journey in obtaining a HELOC, HELOAN using velocity banking and an all-in-one mortgage. Please go back to previous videos to get some of the definitions in general. This is my journey in terms of refinancing one of my properties and using these various instruments that others have talked about. I wanted to bring it to the community, bring a real-world experience in general. I am not a financial planner. I am not an attorney. I am a political economist. I look at the society and the politics and how they interact and how we result in some of the laws that we have. I'll try my best to really stay away from commentary and just try to give the information and the data as I see it, as I've attempted to refinance one of my properties. So we did welcome introductions. We're going to talk about the credit score, appraisals, some major items, next step, and recommendations. What is a home equity loan? A home equity loan, also an home equity installment loan or second mortgage, is a type of consumer debt. This is more debt. Home equity loans allow homeowners to borrow against the equity in their home, more debt. The loan amount is based on the difference between the home's current value, which we get at, and the homeowner's mortgage balance due, which I've talked about. The balance due on this particular property is 28,500. Home equity loans tend to be fixed rate, while the typical alternative home equity lines of credit generally are variable. So I'm looking at getting a variable interest rate in the home equity line, but I wanted to talk about what was a home equity. What is a home equity continued? The key takeaway in trying to understand a home equity is that a home equity, also known as home equity installment loan or a second mortgage, is a type of consumer debt. Home equity loans allow homeowners to borrow against the equity. Home equity loan amounts are based on the difference between the current market value and the mortgage balance. A home equity line of credit, also what I'm looking at getting, is a line of secure credit by the home that gives you a revolving credit card. So that's one of the things that I want to do. I want to get this home equity line, have that revolving credit card, put in my paycheck, put in consulting fees, anything that I have that I can throw at. In the previous videos, we talked about me putting in my $138 that I'm now getting back in taxes this year, and then I'll pay it at the end of the year. But I'm going to use that extra $138 dollars a month to pay down the HELOC once I'm able to get it. Okay, so this is where the townhome that I have in Riverdale, Georgia, according to property valuation, the credit union came back and indicated that the property value is $219,818. Now, when you look at for property value just across the internet, you're gonna come across a number of sites like Redfin has a property at 210. Exome has it at 270. I think that's 270. My screen is being blocked a little. 230. And Zillow has it appraised at 246. However, the credit union came back at 219. Now, if they give, then they had a range of 200,000 to 239,000. Generally, because it's investment property, they're going to give me a value of about 70 to 75% loan value on it. If it was my primary home, I think they can go up to 80 to 90% on the value that they can give me. So of $200,000, they may be able to lend me about $100,000. We had these are our three properties in general. Now, earlier had it appraised at $225,000. I have a $28,000 balance on it and 15 years, and it comes with a 5.75 interest rate. So if I get the HELOC can go up to 14%, and I'm looking to budget at 14%. You may ask, if I'm at 5.75, why would I take a 14% HELOC? Well, the HELOC is a variable rate with a low as 5, a medium of 936. That's what they offer me, but I'm budgeting at 14%, the highest. So I'll be paying more interest, but I'm just putting to my budget that in general. Now I'm using a line of credit. I can attempt to just go ahead and pay it off, but I'm carrying the three properties at 143,000. And earlier I showed you my salary, what I'm bringing home. So I have to still maintain the mortgage. Credit score. Now when I started the journey, I looked at my credit score in general and it seemed pretty high. However, when you get into the weeds with the mortgage companies, they have a different score that they use. In general, I think it's called a mortgage credit score, and I'm trying to find a definition of it. The idea behind this is that you have a consumer credit score, but a mortgage credit score is pulled on you wherever it's coming from, and the lenders don't necessarily tell you, well, where can I find this mortgage credit score as a consumer so that I can see it and possibly try to improve on it before I even apply. But it's proprietary information and they keep it in-house. Now, in terms of just general understanding of a credit score is a prediction of your credit behavior, such as how likely you are to pay back a loan. Companies use credit scores to make decisions on whether to offer you a mortgage or not. They are used to determine the interest rate and credit limit you receive, how much available credit you're using, and new applications for credit. As I mentioned earlier, on my business side, also, one of my vendors reduced my credit limit from 10,000 to 5,400. I had 5,300 on the card. They reduced it because they said there were some negative items on my report, and I had too many inquiries. Now, according to the Dodd-Frank law, you should have at least 45 days to shop around for a mortgage and not have as many hits. But they also had the devil in the details of the credit that they provided me when they showed me the policy. What factors impact your credit score? Your bill paying history, your current unpaid debt, the number and types of loans, how long you had a loan, open accounts, how much of your available credit you're using. When I first started again, I am also authorized user on 2 cards, and those cards are higher for those individuals. So I had a high debt to income ratio. Some of the vendors attempted to exclude me from utilization, but then others kept me on. One lender that looking at 175,000 with a 5.75% interest was able to exclude me, but others were not. Okay, and these are just some of the credit scores that I had. And just like I showed earlier, there's different scores, there's different models. Some people say there's hundreds, some people say there's thousands. This particular one is from Discover Card. It is a FICO score from TransUnion, and I had personal of 740. This next one is a Vantage Score 3.0. And I think the Vantage Score is the industry between the three major credit bureaus that are trying to create their own score or scoring system. This is a credit card that I've been using in general, and with this, they move you to different levels based on your different credit score. This is my FICO score 9 from Wells Fargo. So we saw earlier there was an 8, there was a Vantage score, and then we have a 9. So it's kind of difficult for the consumer to see where is and what is the credit score of me. But I encourage you, one of the first major things to do is go to free credit reporting. I think it's .gov or .com. Pull that credit report from all three bureaus. Is free. Look at it and see if there may be some corrections, and I'll do another video on that. Okay, well, thanks again for stopping by, preparing for day 8. Now that they have the evaluation for the credit bureau, I'm sorry, evaluation for the credit union. I hope we can move forward and it becomes more expeditious. So I'm looking at, I wanted to do an all-in-one mortgage that acts as that puts together your mortgage, your checking, and your savings into one. That's the all-in-one mortgage, and it's easy to maintain, and it hits on the principal if you have a mortgage. But seem like I may have to end up with a HELOC, a home equity line of credit, that's going to act like a revolving card, and they're starting me off with 9.3%, 36% interest, higher than what I'm carrying, even on an average daily balance. But it can go up to 14%. I'm budgeting at 14%, so there's no surprises. It seems like the advantage of it be I can engage in velocity banking, really paying down some debt in general. And once I get that set up, we'll go through that as we look at how things are going. So again, thank you very much for stopping by Dr. Financial Literacy, where your neighborhood political economist works with you and taking you through a real world experience of obtaining what I initially wanted was a fixed 30-year mortgage. Then I moved over to a all-in-one, couldn't qualify for that based on the criteria, but I'm gonna still use that strategy and thinking I've stopped at pretty much a HELOC. So hopefully, again, now the evaluation is in at 218,000. They can give me 100,000, and I can start putting in this strategy. I can do one of two things. I can take one of the properties that's 80,000, or I can take two of the properties that's about 50,000, pay them off in general. In addition to that, I'm still doing small micro loans. So once I get that additional funding, I have some more resources. So if anyone's looking for a micro loan to pay off some high interest loans, definitely give me a call and let's see what we can do. And this is my contact information. So thank you very much for stopping by and hope you have a great day.